What's up, everybody? In today's video, we're going to take a look at Lance Lambert's article in Fortune posted on April 3rd that's titled, "The Economic Shock Hitting the Housing Market Just Got Bigger." And then we're going to take a look at Redfin's economists and how they're reacting to this impending shift. And finally, we're going to take a look at what the Federal Bank Reserve of Dallas is saying about the housing bubble. So let's just dive right in. Lambert starts off by saying the housing economists are clear. The shift upward move in mortgage rates is creating an economic shock. The bad news is that for homebuyers, they were already shocked, so the rising mortgage rates last week is just making it worse. Just since December, mortgage rates have increased from 3%, then to 4%, and now they're at 5%. When the pandemic struck 2 years ago, the Federal Reserve quickly put downward pressure on mortgage rates. By the summer of 2020, rates were less than 3%, which helped bring buyers back into the market. As prices went up, these low rates still help to alleviate the cost for buyers. But as mortgage rates continue to rise, it's going to have the opposite effect. Higher rates will increase buyers' borrowing costs at a time where they're already feeling the stress of the higher home prices, as well as now we have the highest inflation in 40 years. Rising mortgage rates means that some borrowers who have to adhere to the lender's strict debt-to-income ratio will no longer be able to afford to buy the house. They'll simply be outpriced of the market. This is the big difference between 2008 and today. In 2008, lenders didn't have all these restrictions in place, so they would give loans to basically anyone that wanted them, and after a couple years, when that interest-only payment went up, they no longer could afford them. Today, lenders have stricter restrictions in place, which makes a big difference that borrowers who actually do get approved for a loan can't afford it. But hey, let's look at the numbers. A borrower who took on a $500,000 mortgage with a 3.11% interest rate would get a monthly mortgage payment of $2,138. At a 4.67 rate, that monthly payment soars to $2,584. Over the course of a 30-year loan, that's an additional $160,698. So even borrowers who can afford to buy in this market, that additional cost may deter them from buying right now. But even with these buyers that may sit this market out because the cost is just too high, Lambert says that industry insiders say we shouldn't pencil in a housing crash. Instead, many housing analysts say rising mortgage rates should be enough to cool down the market, but not enough to crash it. As buyers back off a bit, that could cause inventory to rise. If the number of US homes for sale, which is still 48% below pre-pandemic levels, that might be enough to break the frenzy that has sent the housing market into unsustainable price appreciation. Logan Mohtashami, the lead analyst at Housing Wire, tells Fortune, the housing market has gone into a savagely unhealthy stage. Everyone should embrace higher rates to cool off this madness and hope inventory rises. Let higher rates do their thing. In March, the US housing market remained red hot, but remember there's about a 30-day lag between when you lock your rate and you close on your home. So these statistics are based on when the house goes under contract and the rate is locked. Buyers that are buying today in April are not going to be as lucky. The Redfin economists are saying that the increase in mortgage rates will end up seeing home price growth start to slow in the next few months. The Redfin economist wrote on Thursday that as rates quickly approach 5%, we expect their impact on homebuyer demand to change from a motivator, a driving sense of urgency to buy before rates rise further, to a deterrent, causing buyers to step back as the cost of home buying exceeds their budgets. There are a number of early signs that this shift is beginning to take place. Take a look at this chart. If rising interest rates can rein in this unsustainable home price growth, even just a little bit, it would be a huge win for their Federal Reserve. Because after all, the reason the Federal Reserve is pushing for interest rates to increase is to limit inflation. So is this crazy, hot, unsustainable housing market considered a bubble? Question of the day. Well, the Federal Reserve Research Bank of Dallas released a paper titled Real-Time Market Monitoring Finds Signs of Brewing U.S. Housing Bubble. The Federal Reserve of Dallas says our evidence points to an abnormal U.S. housing market behavior for the first time since the boom of the early 2000s. Reasons for concern are clear in certain economic indicators, the price-to-rent ratio in particular, and the price-to-income ratio, which shows signs that the 2021 house prices appear increasingly out of step with fundamentals. While historically low interest rates are a factor, they don't explain the entire story of this housing market. Other drivers have played a role, including pandemic-related U.S. fiscal stimulus programs and COVID-19-related supply chain disruptions and associated policy responses. The resulting fundamental-driven higher house prices may have fueled a fear of missing out wave of exuberance, including new investors and more aggressive speculation among existing investors. The Dallas Federal Reserve Bank concludes that based on present evidence, there is no expectation that there will be a fallout like there was in the 2007-2009 financial crisis. People are simply in a lot better shape today than they were in 2008, and fraudulent loans aren't the cause of this housing boom. So let's go back to Redfin for a minute. As I said earlier, the Redfin economists are predicting that home price growth is going to start to slow down in the coming months. They cite that the market still feels hot, but a slowdown in online searches, home tours, and mortgage applications suggests more buyers are getting priced out. They cite in their housing market report on March 28th, mortgage rates are shooting up at the fastest pace in history, sending the typical monthly mortgage payment for a home buyer more than $500 since the beginning of this year. Even with these interest rates increasing, the market is still incredibly hot. There is just a lack of inventory because sellers are just not putting their houses on the market. Lack of inventory creates more demand, which will result in prices going up. Redfin chief economist Daryl Fairweather says, homebuyers may not feel like the market has gotten any easier. That's because they're often competing against investors, all cash buyers, and migrants from expensive cities who aren't as sensitive to mortgage rates. He continues by saying, but there are early indicators that the market is turning, and we expect the softening to become more apparent in the coming week, eventually causing home price growth to slow. We'll be watching closely to see whether the market slows from 100 miles per hour to 90 or 100 miles per hour to 75. So you tell me, does this sound like a housing bubble about to burst or a price correction that's about to come? We can all agree that this market is not sustainable. At least where I am in the DC, Montgomery County, Maryland area. Prices are going way above asking and buyers are getting priced out. It's just not sustainable. So I actually hope that the market calms down. I hope we get more inventory, but based on sellers feeling more comfortable to sell their houses, not on investors dumping homes or foreclosures coming on the market. I guess we're gonna have to see, but for now, when I look at all these different economists spread out and all their different points of view, and I see what's happening in my neck of the woods, I see a slowdown coming, price corrections coming with the increase of interest rates, but I still do not see a housing bubble bursting like it did in 2008. Tell me what you think. I always want to know. Comment below. And whether you agree or disagree with what I think, I do try to give you the most updated forecasts on the housing market. So if you get any value from these videos, please consider smashing that like button, commenting below, and subscribing. It helps us with the algorithm and motivates us to do more videos. Thanks for watching. Bye.